Hello everyone, this is Professor Fang. Today I'm going to share something incredible with you. I'm talking about a strategy, according to the historical data, could theoretically turn $10,000 to $28 trillion in about 100 years. Now please don't just doubt this yet. This isn't a random claim, it's directly from an academic paper. We are going to go through this logically, step by step, and hopefully you really enjoy it and you can apply it somehow. Of course, this is not a financial advice. I only offer information here and offer you the logic here. You have to judge by itself. Remember, all investments involves risks. To understand how this works, we need to grasp two fundamental concepts: leverage and volatility. About leverage, I mean daily leverage. For example, if you want to follow the S&P 500, one of the very famous ETF is VOO. Now you have a 3-time leveraged ETF, UPRO, which tracks the daily return and try to 3x that return. For example, if VOO is increased by 1%, the UPRO chances are close to 3% increase. On the other hand, if the VOO is decreased by 2%, UPRO will decrease by 6%. Then we talk about another concept which is called volatility. In the paper, we see the following table. So there are 3 major rows. One is the S&P 500, one is S&P 500 2 times, which is 2-day daily leverage of that S&P 500. And there is another row which is a 3-time S&P 500. So, and you have 4 paths. The difference between these paths are the analyzed volatility on the last column. You see the volatility are increasing from 0 to 220 something. For example, if you look at the path 1, volatility is 0. The cumulative return for unleveraged asset is 19.41, right? But if you leverage it daily by 2, right? So the increase is no longer 3%, it's 6%. Then the cumulative return becomes 41.85, which makes sense because you're increasing every day, but you are leveraging it every day. So instead of increasing 3%, you are increasing 6%. Same thing, if you leverage 3 times, you get a higher cumulative return of 67.71%, right? So you see that after you leverage it, you get more return. However, this is not true. If you're going down, you get leveraged. It seems very beautiful, right? What about adding volatility? From path 1 to path 4, we see that the volatility is increasing. And you see the return. For example, if you look at the 3 times S&P 500 rows, right? The cumulative return in path 1 is 67.71%. It decreased all the way to 22.25% at path 4 simply because the volatility increased from 0 to 221.4%. You see, there is a big issue with volatility. So up to now, we know 2 things. If you have an upward trend, leverage is good. The good news is that in the US, S&P 500 over the long run has an upward trend. But on the other hand, the volatility will hurt the leverage. Then the authors simply think, okay, can we use a very simple indicator to distinguish the period of time with low volatility with the period of time with high volatility? There are many ways to do that, right? So the authors simply do one thing, which is the moving average. Let's look at the following figure. The idea is that above a certain moving average, of course, you have to pay attention here, it's the moving average of the unleveraged asset. Don't be wrong, otherwise the result will be different. If the stock price is higher than certain moving average value, right, then the volatility tend to be low. Because it's going upward, right, people tend to hold it. But on the other hand, if the stock price going below certain moving average, the volatility tends to be higher. Let's look at this figure. So you see, you have a different days of a moving average, right? 10-day, 20, 50, 100-day, 20-day moving average. And you see that below the moving average, which is the orange ones, the volatility is high. And above that, the volatility is low. Then the strategy becomes very simple, which is If my unleveraged S&P 500, for example, VOO price is below my moving average value, then I sell it, I hold the cash because volatility is high. And on the other hand, if my asset value is higher than the moving average, then I all in buy the leveraged ETF. For example, you want a 3 times leverage and you buy UPRO, right? So we can simply choose 200 days moving average. And this also makes sense because during the time of recession, you have a lot of time below 200 days moving average, and you have only a small fraction, 31.8% above the moving average. By holding cash below moving average, you are avoiding more of the recession. So let's look at the return. So here is a summary of the strategy. I have money, right? I look at the moving average and the stock price of the S&P 500. If the stock price is above 200-day moving average, I all in to UPRO. But on the other hand, if the stock price drops below the 200-day moving average, I sell my UPRO and then hold cash until the stock price going back above the 200-day moving average. That's all. And then over around 100 years, you turn $10,000 to a massive amount of money. You may have one thought, which is maybe the drawdown is big because we do have a lot of good strategies that gives you a very good return, right? But the drawdown is significant. Higher the risk, the higher the return. But that's not true in this case because if you look at this figure, you see the 200-day timing is even having lower drawdown during the big recession, simply because you have that sell timing. If the underlying asset is below 200-day moving average, you're holding cash. You are protecting your assets. So this is the strategy I want to show you. I find it's very logical. Of course, this is a very simple strategy that can be significantly optimized, right? So I'm doing that. Actually, I'm putting $150,000 into this strategy to see whether this actually working. And I'm losing money right now because I just get started. Yeah, I will keep updating on this strategy and it seems reasonable for me. As long as the S&P 500, which is the US economy, is keep going up, I think the strategy will hold. What do you think? Please leave a comment below. See you next time.